I want you to picture something for a second. And I don't mean just a vague idea. I really want you to visualize this. You've spent 10, maybe 15 years building a business.
Right.
You've missed birthdays. You've worked weekends while your friends were out at Braze. You've poured every single cent of liquidity you have into this thing. And it's finally working. You have assets. You have momentum.
You're finally breathing that sigh of relief. It's the moment every entrepreneur works toward.
Right.
The breakthrough.
Exactly. But then one random Tuesday afternoon, you get a phone call. Maybe it's a lawyer serving a summons from a deal that went south 3 years ago. Or maybe it's a creditor calling in a personal surety you signed 5 years ago to get a fleet of vehicles and completely forgot about.
Oh, yeah, and that happens so often.
Or maybe it's just a terrifyingly aggressive audit from SARS. And just like that, because of how your paperwork is structured, everything is on the table. Your house, your personal savings, your kid's university fund, all of it.
It is the absolute nightmare scenario. And the tragedy is, for a huge number of South African business owners, this isn't just a bad dream. It is a mathematical probability.
That is terrifying. But that is exactly why we are here today. We are doing a deep dive into a concept that the source material calls the asset protection fortress. Now, I'll be honest, when I first read that title in our notes, it sounded a bit like a medieval fantasy novel.
A little dramatic, yeah.
Right. But digging into these documents, specifically the Architect's Guide to Trust Beneficiary Management and the insights from trust consultant Lumka Sturman, this is actually an incredibly sophisticated financial strategy.
It really is.
Yeah.
And honestly, it's the strategy that separates the people who just make money from the people who actually keep it. We're not talking about hiding money here. We're talking about building a structure that can weather any storm.
So our mission for this deep dive is pretty clear. We need to figure out how to build this fortress. But more importantly, looking at the notes, we need to figure out the people inside the fortress, the beneficiaries, because it seems like that is where everyone gets it wrong.
That's the people problem. You can have the best legal structure in the world, thick walls, a moat, everything. But if you put the wrong people inside it, or you don't manage the people inside it correctly, the walls just crumble from the inside out.
Okay, before we get to the people, let's establish the core problem, the exposed entrepreneur. I was looking at the risk assessment in the source material, and I actually felt a bit called out.
Most people do.
It says most people have the car in their name, the house in their name, and this is the big one, the trading company, the one taking all the risks, is holding the valuable assets.
Yes. That is what we call a single point of failure. Think about it. If you are holding assets in your personal name, or if you are signing personal sureties without a backup plan, you are effectively naked in a snowstorm.
Wow.
One liquidation event, one bad judgment, and the dominoes fall. Your personal estate is directly attached to your business risk.
So what is the solution then? The sources keep pointing to the trust, but not just having a dusty file shoved in a drawer somewhere. It's a very specific philosophy.
Correct.
Yeah.
The philosophy is simple, but it's incredibly powerful. The trust owns the assets. The company carries the risk. And you control everything without exposing yourself personally.
Own nothing, control everything. I love that tagline. It sounds like something a spy would say.
Whoa.
Or maybe a minimalist billionaire.
It's actually the golden rule of asset protection. If you don't own it, nobody can take it from you.
So let's lay the foundation. Why does a regular business owner actually need a trust? I think a lot of listeners hear the word trust and they think old money or a billionaire with a yacht in Monaco.
That is the most common misconception by far. But this isn't about yachts. This is for contractors, family businesses, medical professionals, engineers, basically anyone with liability exposure.
Right.
The primary why is that separation of powers we just mentioned. If your business goes bust, your personal assets are safe because you don't legally own them. The trust does.
Okay, so it blocks creditors. That's the defense. But the source material lists 3 other massive pillars: succession tax and legacy. Let's talk about tax for a second, because I feel like this is where people really get confused.
It is vital to understand this part. Trusts in South Africa are taxed at a flat rate of 45% on retained income.
Which sounds horrible. I mean, why would I want to pay 45% tax? I'd rather just keep my money. Thanks.
And that's where the nuance is. That 45% only applies if the money stays inside the trust. But here is the magic. It's called the conduit principle.
Conduit principle.
Yes. If the trust distributes that income to the beneficiaries, it's taxed at their personal marginal rate.
Oh, I see. So the trust is like a pipe.
Exactly. It flows through. So if you have a beneficiary who is studying and earns 0 income, and the trust pays for their university fees, that money is taxed at their rate, which might be 0 or very low, rather than your high marginal rate.
That's a huge insight. So you can use the trust to manage your family's overall tax efficiency legally. It's not about paying more tax. It's about choosing who pays a tax and at what rate.
Precisely. Plus, trusts help massively with estate duty. When you die, if you own everything personally, the government takes a massive slice, estate duty capital gains tax. But if the trust owns it, the trust doesn't die.
Right, because it's its own entity.
Yes. The assets don't transfer, so you don't trigger those massive death taxes on the growth of those assets.
Which leads right into succession, ensuring the business actually survives you.
If you die with everything in your personal name, your estate freezes. Accounts are locked. The business might just grind to a halt while the executors fight with the master's office. A trust ensures continuity. It turns a business into generational wealth because the entity never dies. It just keeps operating.
But, and this is a big, but the sources emphasize, you cannot just download a template off the internet and hope for the best.
Please, I'm begging you, do not do that.
Yeah.
That is exactly how you end up in court.
And this is where Limke Sturman's work comes in. Her philosophy really jumped out at me from the source material. She says everyone deserves financial security. She calls herself a trust consultant, not just a lawyer. Why is that distinction important?
It suggests a holistic approach. A lawyer might just draft a deed and say, good luck, send me the check.
Yeah.
A consultant asks, does this actually work for your life? Does it work for your specific family dynamics?
Right. It's not just legal paperwork. It's about education. Because as we're about to see, the structure is totally useless if you get the people part wrong.
Exactly.
Let's pivot to that. The people inside the fortress, the beneficiaries. This was the most complex part of the reading for me. I always just thought a beneficiary was, well, the person who gets the money.
If only it were that simple. The Architect's Guide breaks this down beautifully. You have to understand the nature of the right. The two big ones you need to know are vested and discretionary.
Break that down for us. What is a vested beneficiary?
A vested beneficiary has a guaranteed right. If the deed says John gets the income, the trustees have no choice. They must pay John. John can demand it. It's effectively his property.
Okay. And discretionary.
A discretionary beneficiary, which is the standard for most South African family trusts, has no guaranteed right. They're just part of a pool of people who could benefit. The trustees decide if, when, and how much they get.
That sounds a bit like asking your parents for an allowance. Please, can I have some money? And they can just say no.
That is exactly what it is. And I know as an adult that sounds really annoying. You want control. But here's the aha moment. That lack of control is what gives you protection.
How so?
Because if a beneficiary has a vested right to money, do you know who else can get to that money?
They're creditors.
Exactly. If John has a guaranteed right to the cash caret, his creditors can attach that right. They can step into his shoes. If it's discretionary, John has no claim, so his creditors have no claim. The fortress holds.
That is a crucial distinction. So by giving up the right to demand money, you actually protect the money from the outside world.
Correct. It's a shield.
The sources also mention income beneficiaries versus capital beneficiaries.
Right. Income beneficiaries get the yield, dividends, rent, interest. Capital beneficiaries get the actual assets, like the house or the shares, usually when the trust terminates. And then you have contingent beneficiaries.
The if beneficiary.
Yes. You get this money if you turn 25 and finish university.
It's a way of ruling from the grave, isn't
Or
it?
guiding from the grave.
Yeah.
It prevents an 18-year-old from inheriting a Ferrari and wrapping it around a telephone pole. It ensures the wealth empowers them rather than destroying them.
Fair enough. Now here is where it gets really interesting. The set and forget mistake. The material warns that most people set up a trust, shove the deed in a safe, and never look at it again. But life is messy. Families change.
And when the trustee doesn't change with the family, you end up with disasters. We have some case studies here that are frankly heartbreaking but very educational.
Let's look at the Naidu family. This one is about growth and definitions.
So the Naidus set up a trust in 2005. Beneficiaries were defined as the children of the founder. Simple, right? At the time, they just had their kids.
Sounds standard.
Well, years pass. Grandchildren are born. But the deed said children. In strict legal terms, children does not automatically include grandchildren. If they had used the word descendants, they would have been fine. But because they used the narrow definition, the grandkids were legally locked out of the fortress.
That's wild. One word difference. Children versus descendants? And the grandkids get nothing.
Legally, yes, unless they amend the deed. It shows how precise language needs to be. You think you're being clear, but the law is literal.
Then we have the Henderson family. The divorce scenario. This is a classic, sadly.
It is. A son, James, gets married. The parents being welcoming add his wife to the trust. They want her to feel part of the family.
Which is lovely, until it isn't.
Exactly. James gets divorced. Now, the ex-wife is still a named beneficiary. The deed didn't say current spouse of James. It named who specifically, Sarah. Or just didn't account for divorce at all. So she's sitting there inside the fortress. To get her out, they had to go to court. It took months and cost a fortune.
All because they didn't have a mechanism for removal in the deed.
Correct. A modern deed would have a clause saying if you divorce a family member, you are automatically removed. The Hendersons didn't have that. They relied on goodwill, and goodwill doesn't hold up in court.
Ouch. Okay, next one. The Botha family. This one deals with something really heavy. Addiction.
This is where the discretionary nature of trusts is an absolute lifesaver. One child developed severe addiction issues. The parents realized that giving him money was essentially funding his self-destruction.
So they needed to cut him off.
For his own good, yes.
Yeah.
Because the trust was discretionary, they could stop distributions immediately. But it went further. They actually needed to remove him as a beneficiary entirely to protect the other assets and family members from his behavior, which included theft and harassment.
Wow.
If he had a vested right, they would have been powerless to stop him from draining the funds.
That's tough. But it shows that a trust isn't just about taxes. It's about managing family dynamics.
Absolutely. And then you have the Peterson family. This is the unequal success problem. 3 kids. One becomes super wealthy, a CEO type. One is a struggling artist. One has special needs.
And the parents probably started out thinking, we'll treat them all equally.
Right. But equal wasn't fair anymore. Giving money to the wealthy kid just meant he paid 45% tax on it. He didn't need it. The artist and the special needs child needed the support.
Makes sense.
The trust had to evolve to weight distributions according to need, not just a mathematical third split. If the deed forced an equal split, the family would have lost so much efficiency and support where it was actually needed.
So if you were listening to this and thinking, oh, my trust deed says something I wrote 20 years ago, how do you actually fix it? Can we just sit down at Sunday lunch and agree, okay, the ex-wife is out, the new baby is in?
Absolutely not. And there is a warning in the text about the Daniels family that proves why.
The long-term employee, right?
Yes, they treated this employee like family. Christmas bonuses from the trust mix, verbal promises that she would be taken care of. Everyone knew she was part of the family, but they never formally added her to the deed. When the founder died, she got 0.
Nothing at all.
Nothing. Because in trust law, verbal promises are worth the paper they are written on, which is nothing. The trustees were bound by the deed, and the deed didn't name her.
That is tragic. So you have to do it formally. What are the ways?
There are 3 main ways. First, automatic class change. If your deed says descendants and you have a baby, that baby is automatically in. You don't need to do anything. That's the best way to draft it.
Nice and easy.
Second is trustee nomination. Modern deeds often say the trustees can vote to add someone. You hold a meeting, sign, a resolution, done.
Also manageable.
The third is deed amendment. This is if you need to change the rules themselves, like changing children to descendants, or adding someone the deed doesn't allow for. This is the hard route. You have to draft a legal amendment, get everyone to sign and lodge it with the master of the high court.
And dealing with the master's office is not exactly a walk in the park.
It is bureaucratic, slow, and strict, but sometimes necessary.
Now, there was a knowledge nugget about taxes I wanted to touch on. Section 7C. This sounds like a trap.
It is a massive trap. A few years ago, the strategy was to add everyone to your trust. Cousins, nieces, distant relatives. The idea was to spread the income thin. If the trust makes R1,000,000 and you split it between 20 people, everyone pays very little tax because they are in low brackets.
Smart.
It was. But then SARS introduced Section 7C. We don't need to get bogged down in the tax code, but basically it changed how low-interest loans to trusts are treated. They are now deemed donations.
Meaning what exactly?
Meaning that if you loan money to your trust to buy assets and you don't charge interest, you get hit with donations tax. And having a massive web of beneficiaries makes the administration of this loan account a nightmare. We have the example of the Governor family. They had to remove 12 extended family members because the administration and tax implications just didn't make sense anymore.
So having too many beneficiaries can actually be a burden now.
Yes, the days of stuffing the trust with random relatives for tax breaks are largely over. You need to be strategic. Leaner is often meaner.
This brings us back to the architect, Lemke Sturman. Because hearing all this, Section 7C, the Master's Office automatic removal clauses defining descendants, It feels overwhelming. I'm starting to sweat just thinking about my own paperwork.
You should feel overwhelming.
Yeah.
It's complex law.
Yeah.
That's why the do-it-yourself approach is so dangerous. Lumka's service is built around guiding you through this minefield.
What I liked about her offering is that it's structured. She has this foundation audit.
Right, which is basically checking if your house is built on sand. Is your current structure actually ready? Does it comply with the latest laws? Because laws change. If your trust was built in 1997, it's probably out of date.
And then there's the Fortress Review.
That's the annual checkup.
Mm-hmm.
Are the beneficiaries current? Is the tax strategy still valid? It prevents that set-and-forget disaster we talked about earlier. It forces you to look at the trust once a year.
She also offers an asset protection blueprint.
Which is a step-by-step plan. It includes a risk assessment,
Mm-hmm.
personal versus business. It maps out the asset flow. It's proactive.
There was one more cautionary tale that Lumka highlights, the Pretorius family. And this one connects the trust to the will. I think this is a huge blind spot for people.
This is a classic error. Mr. Pretorius changed his trust deed. He updated the beneficiaries there. But he never updated his last will and testament. So when he died, his will said, I leave my assets to the beneficiaries of my trust. But the trust deed had different people than the will implied, or there was a conflict in the definitions. The documents contradicted each other.
Chaos.
Absolute chaos. Executors and trustees fighting. Legal fees eating up the estate. A trust consultant like Lumka looks at the holistic picture. They ensure the will and the trust are speaking the exact same language.
That holistic view seems to be the key value proposition. She deals with risk tax and family harmony. It's not just about compliance. It's about making sure Thanksgiving dinner isn't awkward.
Or that there is still a Thanksgiving dinner to go to.
Yeah.
Because nothing destroys a family faster than fighting over an inheritance that wasn't clearly defined.
Exactly. So let's wrap this up. We've unpacked the asset protection fortress. It's clear that a trust is not just a piece of paper, it's a living entity.
It protects against creditors, bad marriages, taxes, and life's curveballs. But only, and I cannot stress this enough, only if it is managed actively. If you treat it like a static document, it will fail you when you need it most.
If you are listening to this and you have that sinking feeling that maybe your trust isn't set up right or you don't even have one yet and you're sitting on business risk, stop guessing.
Get a foundation audit. Seriously, you wouldn't drive a car for 20 years without a service. Don't do it with your wealth.
You can go to www.lumkastorman.com. You can join the asset protection waitlist there or book a consultation. Lumka emphasizes education, so you're going to actually understand what you're signing. It's about empowerment.
And remember her mission: to separate ownership from risk. You build the business. Let the fortress protect the wealth.
Before we go, I want to leave you with a final thought.
It's a question, really. If your trust deed was read out loud today, right now in front of your entire family, would it describe your family as it is today? Or would it describe your family as it was 20 years ago?
If the answer is 20 years ago, you have some work to do. Thanks for joining us for this deep dive. We'll catch you next time.
Stay safe.